Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope all of you are staying safe and healthy at this time. We have several important topics to cover today. First, we'll bring Melissa Labonte in with our National Tax Group to talk about what we are seeing in terms of the stimulus agenda following the change in administration. So welcome, Melissa.
Thank you, Leslie.
We also have Jen Rowan to clarify some important questions we are seeing related to employee retention credits. Great to have you, Jen.
Great.
Finally, we have Matthew Rambaran and Christine DeMena to cover PPP updates and new guidance and questions we are seeing from our professionals. Welcome to the two of you. Now, before we dive in today, we have some housekeeping we want to cover. We have the ability for live Q&A again during our session today. In order to participate, you must register and log in using the link below me. The questions are going to appear for you to be able to like and to move those up into priorities so that we can address those. We also have moderators who are standing by ready to engage and interact with you. We also did want to let you know that we have a couple special events coming up. We have a webinar scheduled for January 26th to discuss what's changed after the Georgia runoff, discuss how the market has responded, and more on the 2021 tax plan. Additionally, on January 27th, we have a webinar on key updates to the reporting requirements for provider relief funds. So you can register for both of these events on our website. Finally, in addition to these great events, be on the lookout for articles, white papers, and as always, you can contact your CLA relationship because we absolutely want to talk to you. So with that, let's start with Melissa. Melissa, we have had a change in administration. Yesterday was the inauguration. Do we have any proposals that are already rolling out related to the tax agenda?
Hi, Leslie. To answer your question, yes, there's a lot going on in DC right now. President Biden has already released a major package, a $1.9 trillion package. It's focused on stimulus relief, but there are a number of tax provisions in there. We've also heard from his incoming administration about major changes affecting both businesses and individuals, particularly individuals that have income in excess of $400,000. I should also mention congressional leaders are not wasting any time to roll out their tax agendas. We have Richie Neal, who's in charge of taxes in the House. He's chair of House Ways and Means. He released a detailed tax package earlier this month. And on the Senate side, Senator Ron Wyden has not wasted any time promoting his tax agenda and is expected to release an updated plan. He's had a plan out there for several years, but the latest details and such are going to be coming out very soon. And keep in mind, his plan has major changes not only for the tax rates, but with regards to the timing of when investments might be taxed. So there's a lot going on right now. It's moving very quickly, and you're going to want to know what's around the corner before it happens to help you not only from a tax planning perspective, but also from a cash flow perspective, Leslie.
Well, those are some fantastic updates, Melissa, and we will definitely keep you around for questions because I'm sure there will be some, and I know you have a deep dive on this topic coming up on next Tuesday on the 26th, so we look forward to having you really unpack that for us then, but thank you so much for that quick update.
Thank you.
With that, we are going to pivot over to Jen Rowan. Jen, we have been getting a lot of interest in the employee retention credit, and really there's a couple different things. So we've got a retroactive opportunity and then a forward-looking opportunity. And there's two ways in 2020 that you can qualify. One is the revenue decline and the other is a government shutdown. So can you touch on both of those thresholds and then also the 2020 employee count? Because I think it's important that we talk about the retroactive rules and then the forward-looking rules because they are a little bit different.
Absolutely, Leslie. And I feel like that is the area where we're seeing the most confusion. A lot of people are trying to apply the forward-looking rules to 2020, knowing that the credit opened up, for people who took the PPP loans. So, so to answer your question, which I think was, talk to me about the revenue decline first or the government order. So the business or the organization, in order to qualify, has to either be shut down because of a government order, and the period of time for which they would claim the credit would be the actual dates of the government order. And by that, it is a government order and not a CDC guideline. So you would actually see a shutdown issued by the governor or mayor or some official, and it's a written order. So hopefully that gives some clarity. In the alternative, you could qualify for the retention credit because of reduction gross receipts. In 2020, that means you have 50% or less of where you were in the same quarter in 2019. And that's when you can start taking it. You can take it for the entire quarter, unlike what I just said for the government order, it's the dates. This would be if in one quarter the reduction of gross receipts was, amounted to 50% or less of where you were for the same quarter in 2019. And then you can continue to take it until such quarter where you reach 80% of the same quarter in 2019. So that's the reduction of gross receipts for 2020. And then the last piece is the threshold. So what does the threshold mean? If you have 100 or fewer employees, regardless of the number of employees you have, you may take the credit. It's just what wages do we include in the credit. So if you have 100 or fewer employees, you can take, and you have the reduction in gross receipts or shutdown, you can take the credit, or you may take the credit on all wages you pay. Then to the extent that you have greater than 100 employees in 2020, you may only take the credit for wages that you pay the employee when they're not working. So those are the important thresholds and distinctions for 2020. And of course, keep in mind that the entire time you cannot be taking the credit on wages that you've used for PPP forgiveness.
So that's a really good kind of backwards looking summary. And now the opportunity, I think, really starts to also come in 2021, because it really kind of opens up that population even broader in 2021. So let's now compare the eligibility for the gross receipts decline, the employee counts for who's working and not, and any other important details for the 2021 opportunity.
Sure, and there are a few. Obviously, the government order rules stay the same, or you have this gross receipts reduction, and that reduction is if your quarter one 2021 gross receipts are at 80% or less of where they were in quarter one of 2019, and your quarter two 2021 gross receipts are at 80% or less of where you were in quarter two of 2019, you definitely have the ability to take it. So it broadens the test for revenue reduction. Instead of being behind 50% or more, you're only behind 20% or more. So that's much more generous, right? In 2021, that threshold where I said you're able to take it and take a look at the wages for all employees being paid regardless of what they're doing, that threshold number goes up to 500. So once you're over 500 employees, again, the credit's only for wages that you pay to employees who are not working. And then the other key distinction is the amount of the credit. So in 2020, we could only take it for up to $10,000 of wages and qualified health benefits that the employee made from March 15th through the end of the year. Now it's $10,000 per quarter. And instead of it being 50% or a $5,000 credit per employee, it's a 70% or $7,000 per quarter per employee credit. So each employee in 2021 could yield $14,000 in credit. So those are probably the three key distinctions.
Well, that is a really awesome overview. So thanks for just clarifying the retroactive opportunity and then the forward-looking opportunity. The other important thing that we have to keep in mind, and we'll talk about this too with the PPP when we get into that today, is attribution and affiliation, and that matters here for both the employee thresholds when we're looking at was that person working or not for qualification, but then also when we're looking at revenue reduction, that can matter too. So talk about how we test for affiliation here.
Sure. So the employee retention credit generally follows the controlled group definitions and the tax rules, which require all companies to be treated as a single employer if they meet one or more of the following criteria. So first, if you've got a parent-subsidiary relationship, all members of the parent-subsidiary group are included together where the parent owns 50% or more of the voting power or value of the company. If you have a brother-sister controlled group with 5 or fewer individuals, estates, or trusts own more than 50% of the combined voting power, you have to, or the value of each stock of each company, considering only the stock ownership percentage of each shareholder that is identical with respect to the corporation. So that's a little bit more confusing, but certainly if you have a controlled group for purposes of the code definition, where you've got more than 50% of the combined voting power, you will have this. You will have to aggregate for purposes of the employees and the gross receipts. And then if you have a combined group, so this group exists if there are 3 or more corporations, each of which is a member of a parent subsidiary controlled group or a brother sister controlled group, and at least one is both the common parent corporation of the parent subsidiary controlled group and a member of the brother sister controlled group. So lots of words there to essentially say, look to section 52A and B of the code for purposes of the attribution rules and make sure that you're aware of them so that you're not separating out. If you are in a parent sub relationship or you're part of a controlled group, what we wouldn't want you to do is take all of the wages, assuming that you are below those thresholds, or miscalculate your gross receipts, again, thinking that you're below the thresholds and take the credit when you weren't entitled to it.
Yeah, so I think that's a great overview, and certainly that can get complicated. It can get complicated when we're looking at PPP too. So I think an even more important message here is that if you are facing that situation and you don't know, contact us because we absolutely can help you work through that, and we want to help you work through that. So thanks for that overview and insight too, Jen. So I think the last important thing on the retention credit that we should discuss is just the fact that you alluded to. Now there's this lovely interplay that we've got with the PPP, and it's a really neat planning opportunity, particularly if we haven't filed for forgiveness yet and we can take advantage of both. Why don't you talk about where that planning might exist and what kind of fun you might be able to have if you're thinking about how do I get creative and do some planning here?
Absolutely, and that's such a great question. So if you have not yet filed for forgiveness, and you were considering using 100% of, trying to file for forgiveness using 100% payroll, maybe take a look at backing back out. You're still held to that 60% test. So you need to use some payroll dollars, but if you can get some other qualifying expenses in there, and I know we'll talk through what those are, so I don't want to steal anybody's thunder, but if you can use some of those qualifying expenses to reduce the amount of payroll that you use to submit on your forgiveness application, the payroll number that you have left over could be applied towards qualifying for the retention credit. Same thing goes in 2020, as you're applying for PPP loans and figuring out how am I going to use these best, maybe consider how can I earmark the dollars, the other payroll dollars, to take advantage of the retention credit. So really wonderful planning opportunities, really a good opportunity to revisit the expenses to determine whether they were eligible for PPP forgiveness. A lot of people were asking the questions, very concerned about it. And then when we had the 8 to 24 week covered period switch, everybody's like, well, sure, I don't have to worry about those expenses anymore, and stopped asking the good questions because they were just going to throw all the payroll at it. Now I would say, let's have that conversation again if you haven't applied for forgiveness, and let's think about that in 2021 as you're planning the use of those funds.
Awesome. Well, thank you so much for that summary. I know that we are getting questions, and so we will bring you back for those as we get some questions on that. Because we just talked about PPP and the planning we can do with the retention credit, it is such a good segue to our friends Matthew and Christine. And so I would like to bring them in now to talk about some of the procedural and other updates we've received this week. So, Matthew, I would like to start with you. Welcome back. And the Treasury has issued a number of procedural notices. One of those has to do with excess loan amount errors. We had not really had any idea what to do with this previously, so it was welcome guidance. But can you talk about what's considered a loan error, if you will?
Absolutely. I'm glad to be back and happy to unpack the new procedural notice. So, effective January 15th last week, the Treasury released a procedural notice with the subject of Paycheck Protection Program excess loan amount errors. The notice informs the Paycheck Protection Program lenders of the effects of an excess loan amount error made by the borrower or the lender in completing the PPP borrower original application form. So the notice defines that an excess loan amount error is a borrower or lender error made in good faith that caused the borrower to receive a PPP loan amount that exceeded the borrower's correct maximum loan amount. Now, they further state that an excess loan amount in error does not include a knowing misstatement. However, they clarify that a knowing misstatement may result in additional action, such as charges for fraud. So this becomes critical when applying for second draw and potentially reusing support and amounts claimed on the round one or first draw. Now, the notice provides a couple examples and a couple common borrower errors. Two of those are mistakenly failing to subtract amounts paid to employees in excess of that 100,000 limitation, and then mistakenly including payments to independent contractors in its calculation of payroll costs. Now, lenders too have also made errors, and a common error on the lender side is inadvertently applying or approving a loan due to a data entry error. So an example would be the borrower applied for 24,000 or 25,000, but the lender inadvertently entered 35,000. Leslie.
Yeah, so I think that's a really just good snapshot and summary of what that could look like. And we know that early on there were questions in calculating that PPP and round one loans. So it makes sense that the SBA is releasing guidance on this. And so under that guidance, what is the effect of an excess loan amount error on loan forgiveness?
Yeah, that's a great question, and the guidance does provide a nice, guidance as to regards to what to do. Now, a borrower may not receive loan forgiveness for any amount that exceeds the correct maximum loan amount permitted by the statute for that borrower. So this is true whether the excess loan amount was caused by both the borrower or by the lender. So regardless of who caused the error, no loan excess will be forgiven. Now, the notice provides some requirements, and these are geared towards the lender. That identifies the error, stating that if a lender identifies an error prior to submitting the forgiveness application to the SBA, the lender must issue a decision to the SBA denying forgiveness for the amount that exceeded the borrower's correct maximum loan amount. Now, if then an excess loan amount error is discovered after the lender's already submitted that forgiveness decision to the SBA, the lender should promptly request withdrawal of the lender loan forgiveness decision by notifying the SBA through the SBA's Paycheck Protection Platform. The lender can then at that point resubmit a new lender forgiveness decision with the corrected amount after withdrawal. Now, if a lender or the SBA determines that the borrower was ineligible for any portion of its loan amount, forgiveness will be denied for the ineligible portion, and the borrower must begin making payments on the remaining loan amount. So any unforgiven loan amounts remain the obligations of the borrower, even if the borrower was ineligible to receive some or all of that loan. So now let's apply this to the second draw loans. So when sizing second draw loans, if the errors are presented from when you use 2019 results, if you know that there's an error, that potentially becomes a knowing misstatement. So just to kind of reiterate, knowing misstatements, may result in additional charges of fraud. And I hate bringing, bringing those scary terms up, but I do want to mention
fraud.
Exactly, us auditors. But I do want to mention that there's heightened scrutiny on round two. So, just make sure you're following the rules and the guidance. Back to you, Leslie.
Awesome. Well, I think that's a really important procedural notice, particularly because we're getting into that next program. And so there was also another procedural notice that was released. And Christine, I want to talk to you about this one related to reapplications or requests for increases in first draw PPP loans. So give us an overview of who might be eligible to reapply or maybe expand that first draw loan.
Absolutely. Thanks, Leslie. So the recent notice for reapplication or increases applies to any first draw PPP loans that were approved on or before August 8th of 2020. And if you've already started paying or your loan has been partially or fully forgiven by the SBA, you're not eligible to request an increase or a reapplication. If you are in that situation, you could always explore a second draw loan. So the situations to reapply or request an increase are very specific to certain scenarios. Partnerships that did not include partner compensation in their maximum loan calculation. Seasonal employers where the application of new methodology where you can select any 12-week period between February 15th, 2019 and February 15th, 2020, when you're determining your maximum loan amount, is higher than your original methodology. And finally, for farmers and ranchers, where the application of the revised formula for the maximum loan amount is higher than the original methodology. There are very limited other circumstances for certain borrowers as well who fully repaid their first draw loan prior to December 27th, 2020, returned part of their first draw loan, or did not accept the full amount of their approved first draw loan prior to December 27th.
So that's a really good overview of that procedure. So what about borrowers, though, who calculated their loan amount incorrectly and could have qualified for more? Let's talk about that.
That's a great question and one I've been hearing quite a bit. Unfortunately, unless the borrower meets one of those very specific situations, they would not be eligible for an increase in their first draw loan. So that borrower must have been approved for a certain amount and then accepted less. Just applying for a lower amount than the maximum from the beginning would not satisfy that criteria. However, those borrowers, if they are eligible for a second draw loan, certainly should go back and update their loan sizing calculation to ensure that their second draw loan is maximized. And as a reminder, second draw loans can be sized using calendar 2019, calendar 2020, or the trailing 12 months, which right now is still calendar 2020.
Yeah, so a couple options there. What are the pros, though, and the cons of applying for an increase in a first draw loan?
So the pros, I think, speak for themselves. If you're eligible and you have not submitted for forgiveness, you could receive additional funds. So that's always great. Some potential downside or things to consider. If your first draw PPP loan is under SBA review, or the SBA has information that indicates the borrower was ineligible for that first draw loan, you're considered an unresolved borrower. And loan increases and reapplications are not able to be processed for a borrower with that status. Now, the SBA has said that they will try to resolve those situations as quickly as possible. Another thing to consider is that borrowers must have used all of the proceeds from their first draw PPP loan prior to applying for a second draw loan. So we would assume that if your increase is being processed, you could not have used all of those first draw funds yet. And then finally, requests for increases as well as those second draw loans are subject to availability. So the processing of a first draw increase could potentially delay your second draw application, hopefully not, but potentially to the point that that funding was no longer available to you.
I am back. Leslie appears to be having a couple of technical issues, although I see you moving again in our behind the scenes area. So, Leslie, I'm going to try to toss it back to you to see if we can hear you again.
I think I'm back. Here I am.
I think you are. Yes, I can hear you now.
Wonderful.
So we'll keep you in that seat for now if we can.
Let's cover to Matthew now. So we are getting some questions on affiliation, and Jen talked about affiliation with the retention credit. We have to deal with it here too. So when determining eligibility, the affiliate rules have to be considered when we're talking about the 300 or the 500 employee test for the first and second draw loans. And they also have to be considered for the revenue reduction test for second draws. Give us a refresher. We've got a lot of family-owned businesses that can be complicated structures here, or maybe they're private equity owned. What do we need to think about when we're looking at affiliation?
Absolutely. Last April, I think it was in April, the SBA released a 2-pager on the affiliation rules, and they were applicable to the PPP program specifically. So as you mentioned, they provide tests. There's 4 tests for affiliation, and those tests are primarily based on control. So for the purpose of determining the number of employees of an applicant to the Paycheck Protection Program, the applicant is considered together with its affiliates. So if you're filing for first draws, that threshold is 500 employees, and for second draw, that's 300, including both foreign and domestic affiliates. So jumping into the rules, concerns and entities are affiliates of each other when one controller has the power, as we mentioned, primarily this control factor, to control the other, or a third party or parties controls or has the power to control both. Now, it doesn't matter whether control is exercised so long as the power to control exists. So what we'll do is we'll break down the 4 tests. The first test is going to be the affiliation based on ownership. So for determining affiliation based on equity ownership, they provide a 50% threshold based on voting or voting equity or voting interest. If no individual concern or entity is found to have that control, the SBA deems the board of directors, a president, CEO, other officers, managing members, or partners who control management of the concern to be in control of that concern. So a minority shareholder could actually be in control if that individual or entity has the ability under the concern's charters, maybe bylaws, a shareholder agreement, to prevent quorum or otherwise block action by the board of directors or the shareholders. So in general, 50% voting interest or voting ownership will easily create control, but if that does not exist, it goes to management and potentially a minority shareholder who has the ability to block or prevent actions. Now, the next test 2, is going to be affiliation arising under a stock option, convertible security, or an agreement to merge. This one gets a little bit tricky, but let me see if I could kind of unpack it and break it down a little bit for you. So in determining size, the SBA considers stock options, convertible securities, and agreements to merge, including agreements in principle to have present effect on the power to control a concern. So the SBA treats such options and agreements as though the rights have already been exercised or the rights have been exercised. Agreements to merge could create affiliation taking present effect. So we would suggest consulting with the attorney to identify the substance of that agreement. Now, the SBA further states that agreements to open or continue negotiations towards possibility of a merger or a sale of stock at some later date are not considered agreements in principle and are thus not given that present effect. Options, convertible securities, and agreements that are subject to conditions which are incapable of being fulfilled, speculative, conjectural, or unenforceable under the state or federal law, or where probability of the transaction occurring is likely to happen, are not also given present effect. So they then add, what I think is somewhat interesting language: an individual concern or other entity that controls one or more of the concerns cannot use options, convertible securities, or agreements to appear to terminate such control before actually doing so. So what they're saying is that the SBA will not give present effect to the ability to divest all or part of ownership interest in order to avoid these affiliation rules. There's 2 final tests, and we could kind of quickly go through these. Affiliation based on management. We kind of talked about this already, but a CEO, a president, or other officer, manager, member, or partner who controls management and also controls management of the other concerns will be treated as affiliates. And then now finally, affiliation based on identity of interest. And that arises when there's an identity of interest between close relatives, so a brother, a sister, a cousin, husband, wife, as defined with identical or substantially identical business or economic interests. And they provide an example, such as where a close relative operates a concern in the same or similar industry in the same geographic area. Now, where the SBA determines that the interest should be aggregated, an individual or the firm themselves may rebut that determination, but they're going to have to provide evidence showing that the interests deemed to be one are in fact separate. So there is opportunity to provide a position, to maybe argue that position if the SBA determines the aggregation of the affiliate is required. Both the CARES Act and the Economic Aid Act waive some affiliation rules for certain categories of borrowers, such as the NAICS 72. So those are the accommodation and hospitality. Eligible news organizations were brought in, and any business concern operating as a franchise that is assigned a franchise identifier code. So the operators of those franchises now can participate. So hopefully this helps our viewers with understanding, some of the complexities behind the affiliate rules and what constitutes an affiliate within the parameters of the Paycheck Protection Program. Once again, these are complex and tricky, so feel free to reach out to our members. Back to you, Leslie.
Yeah, that was a great overview. So we do have a couple questions that we would like to take from our viewers. The first one is related to the retention credit. So Jen, we've got a few people who obviously filed their 941s because they didn't know they were eligible. Maybe they were doing the PPP and just assumed they weren't eligible. Now that was cleared up. So if they filed for Q2, Q3, how do they go back and get those? Should they be amending those prior 941s? Catching that up? What does that look like?
So we're still waiting for a little bit more guidance on this, like everything, right? But we believe that if you have yet to file your 941 in fourth quarter, or for fourth quarter 2020, so you still have until the end of this month, you could catch it all up on your fourth quarter 941. And then that would probably be the easiest way to request the refund. Now, if you've already filed that, the big question that I'm seeing, and this is where we're really looking for guidance, is if you had, which quarter do you amend? Where do you file that 941X, right? So I think it's an obvious answer if you were eligible for and you have employee retention credit in like quarter 2, 3, and 4, that you could just put it all in an amended fourth quarter one. But then the question of like, well, what if I just had 2 and 3? For that, I would say, like everything, wait for guidance before you proceed in that fashion, just because we don't know and we'll likely find out soon.
Awesome. We have another retention credit question. As I told you, this has been a hot topic as people are really discovering that there's an opportunity here. So people have heard about a week ago what constituted gross receipts for the Paycheck Protection Program, but now they want to know, okay, well, what do gross receipts mean for the retention credit? And especially if I've got a Schedule C or a Schedule F, what do I do with these items? So what does that mean?
So the gross receipts for purposes of the retention credit has the same meaning as when you would use it under Section 448C of the Internal Revenue Code. So under the regs for that, and sorry, I'm looking at this a little bit more closely so that I say it correctly. So under, and I apologize. So under the regs, the gross receipts mean the gross receipts of the taxable year, and generally do include total sales and all amounts received for services. So in addition, that could also include any investments, to your question, from any income from investments, from incidental or outside sources, or interest, discount, tax exempt interest, dividends, rents, royalties, and annuities. So I think it's important to refer back to 448C of the code and the regs if you've got questions, but that's where you're going to find your answer for purposes of the gross receipts test.
Awesome. Well, thank you so much for clarifying that. I'd like to ask our PPP team now for a quick question or thought. We talked a little bit about planning opportunities that might exist with the retention credit and the PPP interplay, and I'd be curious what you guys think are some things to consider and think about as you're applying for forgiveness in ways that you might optimize both opportunities. And I don't know, Matthew and Christine, if you guys have thoughts on that.
Yeah,
Sure.
Christine, if you want to jump in.
Oh, sorry. So I would just say that if you have not yet filed for forgiveness for your first draw, you definitely should go back and consider, one, are you eligible for the employee retention credit now that the guidance has changed? And then see what you have in your forgiveness application. And if like we mentioned earlier, you have loaded it with the payroll costs because you went for the 24-week period, is there an opportunity to pull some of that cost out and replace it with some of those non-payroll costs, including those newly eligible non-payroll expenses, such as for software, employee and protection equipment, and other items that were recently added. So there is an opportunity to reassess that and make sure that you're only using what you need for the PPP and leaving everything else for opportunities like the employee retention credit.
Awesome. Okay, Matthew, I have another question related to economic necessity. So again, 2 million was this threshold for maybe some type of a safe harbor under the first round. Will that apply with the second round? What do we know right now?
They haven't said anything yet. In I think it was fact like 31 or like 31, 37, and then 46. It was kind of weird. But in fact 46 possibly, or 31, whatever the fact is, they talk about loans under 2 million meeting that economic necessity in good faith without actually having to demonstrate that. Loans over 2 million, if we remember back late fall, they released the 3509 and the 3510 loan necessity questionnaires. Now, bringing that all to light, this second draw, it has a little bit more scrutiny, it has more eyes on it. They've reduced some thresholds, so from 500 employees to 300, from 10 million max to now 2 million. I wouldn't be surprised if they added some additional demonstration on the back end. We can't be certain. If they were to do that, they would have to go back in and amend some of the original facts, as we mentioned, the fact 31 or 46, whichever it is. So to answer the question, I think be cautious. Definitely document the loan necessity. And even if you're under 2 million, the 3509 loan necessity questionnaire and the 3510 questionnaires are great metrics to really help drive home exactly that need. What were your revenue reductions? What was your liquidity? What other, what were the distributions you may have taken? Some of these things you might want to look at and maybe, help kind of drive that loan need.
Awesome. Well, thank you so much to everybody. And unfortunately, that is all the time that we have for today. Thank you so much to all of our speakers. We also appreciate all of our moderators who have been in the discussion answering your questions, and all of you for your engagement and your questions. Please register, continue to engage with us. We love having you be part of the conversation with us, and we will see you next week. But until then, stay safe and healthy and have a wonderful weekend. Thank you so much.